Hi there, Tyler here with Seller Accountant, and this is a series, How Do I Value or Appraise My E-commerce Business? This is the third session within this series. And in the first session, we talked about kind of an overview of how valuing different assets, especially in the business world, works, how e-commerce is unique in that it's still complicated like other small businesses, but it's a little bit more homogenous and it's easier to find comps so that we can talk intelligently about the value. The second video, we really got into the nitty gritty of the kind of meat and potatoes of how to measure seller's discretionary earnings, which means you have to take your profit and add back certain expenses that your investor will not inherit. And then there's also going to be applied a multiple to that annual SDE. But that doesn't complete the formula, so to speak, for valuing your business because you're going to have some inventory on your balance sheet. So we're going to talk about that in this video. Let me go ahead and pull up so I can give you an idea here. This is the same sheet we were looking at in the last one. And remember, we came up with an SDE, a seller's discretionary earnings of $185,000. And I listed a range of potential multiple values in the market. Let's just say that the market will pay 3 to keep it simple here. So I picked the one in the middle. And so the business is worth $555,000, right? Well, no, because we're missing an important variable. You have some of your hard-earned cash or working capital in the business that you're going to want to be compensated for at the closing table. And frankly, your buyer wants to incentivize you to continue to invest in good inventory, not bad inventory, which we'll talk about here in a second, but in the right kinds of inventory. And so let's just say that on your balance sheet, you've got great accrual accounting, your books are solid, you can validate your costing and your sales transactions. But let's say that at the end of this trailing 12-month period that we've been describing, let's say you have $120,000 sitting in your warehouse, so to speak, in sellable inventory. And just to be clear about how we value inventory really quickly is you only value inventory at your cost. If I spent $10 per unit for the product that I bought, and I have, X number of units, it's going to give me, right? So, if I had whatever, 12,000 units at $10 a piece, I would have $120,000 in inventory in my warehouse. I'm not going to try to value it on what I think my customer will pay for it. That's wrong. I want to value it on what I paid for it. But this is my money. I had to borrow this $120,000 or I had to invest it into the business. And so I should be compensated for that cash. And the investors agree with you on that. And so what ends up happening is that the total value of your business ends up being your multiple. So for this one, the value of the cash flow is $555,000 because we agreed on a 3x multiple. And then we're going to add to that $120,000 in inventory on the balance sheet, giving us a total value of $675,000 for this business. Now, a couple of kind of caveats that I want to add in here. And again, I think this will be a little bit of a shorter video. But what's really important to your investor is they don't want garbage inventory. And so they're going to scrutinize your warehouse and they're going to look at all 25 SKUs in your portfolio and say, wait a minute. These two, they're not moving. These are trash. These are dead weight. And so we're going to say that value, let's say, for instance, maybe that was $15,000 of this $120,000. They're going to make you deduct that trash and only give you the remaining $105,000 as value. I don't know if that makes sense, but they're going to make you cull your inventory. And so a good best practice, if you're maybe 6 months before going to market, is take a really cold, hard look at your catalog and see, do I have any really slow moving SKUs? Do I have any that are not making me any money? Could I simplify my catalog in some meaningful way? Because I really thought that I needed to have, the red, yellow, and green one, but it turns out that no one likes the green one. Let me get rid of the green one. Having that kind of optimizing effort into your business before you go to market can a lot of times help because you're gonna have to eat the inventory anyway if a good investor really scrutinizes your books. And this is another reason, again, you got to have great bookkeeping to make sure that you can validate and support your assumptions and your assertions on inventory value. But basically, that's what it all comes down to is you're going to have an inventory value. And here's what it normally looks like, because you're going to get under LOI or letter of intent at an agreed upon value for the business. And normally there's going to be some language in that LOI that says, hey, I'm going to pay this $555,000 for the business, plus some factor for inventory. This is something that you'll negotiate, and then you'll true up the value at closing to capture that working capital again, so that the investor can encourage you to continue buying good inventory. You're just buying it for them. They're going to compensate you for it. But also they want to encourage you not to buy garbage inventory. And so there's going to be some accountability for you to not buy crappy goods, that kind of thing. And so that's all I want to say about inventory. That's what completes the valuation formula for an e-commerce business. Is going to be seller's discretionary earnings times some market-based multiple, which, by the way, in the next two videos, we're going to talk about deal structure. And then the final video, the things that drive up those multiples. These multiples are dependent on a lot of factors, but I'm going to share some of those with you. And then once you arrive at that multiple value, you're going to add to it some factor for sellable or good inventory. Hope that helps you guys. Look forward to talking to you in the next video. Take care.